Dicky here, and I want to give an update on the PCE inflation from today and where I think that's going to go with the market going forward. I'm going to use this video, and it's a relatively dry video. There's a lot of data in here, but I'm going to try to stop and start and talk about a few things in it because there's a lot of information that talks about the key inflation and how the overall effect is going to be on the market.
Those numbers. Hello, Rick. Yes, hello, Mike. And we can see that yields are dropping. The data is trickling in. Let's start out with.
Okay. I'm stopping very quick, and I'm going to probably do this quite a bit in this video. The first thing I want to make sure we're listening to is the fact that bond yields are going down again. Now, understand the market is really tracking where the bond yields are going. So the data that he's going to talk about is making the bond yields go down. It's going to have a positive effect on the market, at least in the short term.
With jobless claims, 228. That's below expectations of 235,000.
So we have 228,000 jobless claims versus expected 235. So in the world that we're in right now, where what's bad is good and good is bad, in theory, that's a good thing. We have less claims, but it's less than expected. With the information he's giving us, this is actually a bad thing for the market because it means that there's not a lot of jobless claims coming. Okay. Let's keep going on this.
And 228,000 is the lightest in the month of August. You have to go back to the last week in July. Continuing claims from the week of August 19th, always a week in arrears, 1,725,000, very close to expectations. 1,725,000 actually is the highest level, going all the way back to the first week in July. Now, personal income and spending, income up 0.2, 1/10 lighter than expectations. If you look at the spending side, 1/10 stronger than expectations.
One's a little bit low, one's a little bit high. So they basically offset each other. As I keep saying, so a lot of this stuff you can't look at on a 1 month drag on these things. You got to look over time.
Up 0.8%, up 0.8%, best number of the year outside of January, whereas at 1.9%. If you adjust for inflation, real spending up 0.6. That's pretty juicy. Also, the second.
So real spending, and again, we can debate whether these numbers are accurate or not accurate, but what he's also saying is that we're increasing the spending, which is going to be inflationary. We're not seeing a decline in any of this stuff yet. We're not seeing this decline. The consumer's continuing to spend.
Second highest number of the year outside of January's 1.3. Now buckle up. The Moneyball, 4 sets of numbers. The month over month, year over year, some of the favorite inflation gauges of the Federal Reserve. The PCE deflator on a month over month basis is up 0.2%, exactly as expected.
Now, it's up 0.2% as expected. Now, in one of my previous videos, when I talked about CPI, the question isn't whether it's as expected. The question is, are we going in another trend going in the other direction? Which means, heck, did we bottom in June? And are we going back the other direction?
Light watermark, the low watermark this year has been 1/10, and that was twice back in May and also in March. The high watermark, June of 22, where it was up 1%, the highest since 1981. If we take a deflator year over year look, up 3.3, exactly as expected. However, it is 0.3 higher than our last look, which is 3.
Okay. So this is where I'm trying to focus everyone on, because it's basically the same thing that's going on with CPI. It's in at 3.3 versus 3, which means it's now up for the first month and over a year. Now, as I continue to tell you, everyone, it is not what the data is. It's how the market responds to the data. But are we seeing a trend going the other direction? Everyone talks about inflation being sticky. Okay. And the concern for the Fed is inflation actually coming down and staying down, which I find very interesting on some of these comments.
3.0. That's never a good thing. High water mark there, June of 22 at 7%. That was a 1981 comp. If we look at the core deflator on a month over month, up 0.2 as expected, up 0.2 is pretty much where we were looking for this to come in. The best it's been, it was up 1.6 0.17, our last look, that's rounded to 2/10. I think it's an important distinction, and maybe the most important number of all. The personal consumption expenditure core deflator year over year, 4.2, 1/10 hotter than our last look at 4.1, high water mark there, 5.4.
Okay, so again, it's hotter than expected. It's at 4.2 versus 4.1. Now, again, I'm not going to freak out over one print, but the question really is, have we tamed and brought down inflation? And we don't know the answer to that yet, because again, this is 1 month. So it's going to be interesting to see how the market responds to this, just like the way it responded to CPI. And if you remember, back when CPI came back out on the 10th, the market went backwards. And only when the data started showing that the market was coming down with jobs over basically this last 5 days, the majority of August is down. The last 5 days it's come back because everyone's thinking that everything is fixed, that we've got inflation under control, which is again, just the opposite of what was happening for the month prior to. So it's going to be interesting to see how this goes on.
1% in February of last year. That was a 1983 high. And what is noteworthy here is that we obviously have been in this 4% range, and many analysts, economists, and Fed officials have pointed to this as the sticky area. Interest rates did move lower, were very volatile, but we're hovering at 4.09, maybe 1/10 difference. If you look at the pre-opening equities, they are still on fuego. And to me, all you have to think about is what occurred last week. Jackson Hole, stocks are up how many days in a row? I think we could connect the dots there. What is one of the motivating forces of stocks?
Which again, when you look at the bond yields as they continue to come down after Jackson Hole, again, it's not hard to connect the dots, just like he's saying. But what I found interesting about this were the comments, and not just on this particular one, but what it's saying is that it's coming down despite the apparent strength in real demand. Inflationary pressures continue to ease. And maybe I've missed something here, and I truly hope I do, because what I'm seeing isn't continued easement. What I'm seeing is that we've bottomed, and maybe we're going across, but CPI this month was not continuing to go down. PI wasn't continuing to go down, and PCE isn't going down anymore. They're all up. Now, again, it's minor, and maybe that's what we need to have, and we'll continue to go down next. But I don't see the continued easing here. Again, maybe I'm seeing something that's not there, and maybe they're seeing something I don't. I'm not exactly sure. But what I am sure of is I'm not concerned about today. The market's going to react to this, and what happens on the day things come out doesn't necessarily mean how the market's going to react to it. It's usually 2, 3, 4, 5 days later, which is why we know really how the market was responding to Jackson Hole because of the last 4 or 5 days. That's how you know. Just because something comes out doesn't mean that it's going to stick there. Same thing that happens when you have stocks that come out with their quarterly numbers. It might jump initially 20%, and then 5 days later, it's back down to where it was. That just means that the market really didn't accept what happened. The only time when something like that happens, you have a big move up. If it stays there over a period of time, then it's going to stick. So again, don't look at what's actually happening here today on this information. Look at what's going to happen over the next several days, barring some other information that's come out. Again, Jackson Hole is a pretty good example of that. There really hasn't been any other data that's come out the last couple of days other than the employment report yesterday, but it was already doing its thing. It turned around on Friday. Monday was good. Tuesday was good. Yesterday was good. I think in spite of the jobs report personally and some other things that came out there. But again, some other things are driving this. You've got bond yields coming down, but part of that is just because of how the market is responding to what Jay Powell is doing. My opinion, keep an eye on this. I think we've got some setup going forward that might become a problem with inflation. So when CPI comes out on the 10th, I think that's a bigger issue than PPI, because if we have 2 months in a row where CPI is going up, I think you're going to get some questions as to whether we've actually tamed down inflation. Because prior to Jackson Hole, we had an 80% chance that Powell was going to raise rates by a quarter coming in September. Yesterday, it was down to less than 50. If we see CPI go up and PPI go up on the 10th, I think you're going to see that percentage go back up. And I think you're going to see bond yields go back up again. And so what I'm suggesting is keep an eye on this. This is going to be some turbulent times over the next several months, trying to make sure we get inflation where Powell wants it to go and get more clarification on where he's going, whether he's going to increase that terminal rate. Make sure you get with your financial advisor, make sure your portfolio's set up for your long-term goals and objectives, as well as your short-term goals and objectives. Dickie out.